Hello, chart watchers, and welcome to this Thursday, January 3rd, 2019 Market Watchers Live Show with your host, Tom Boley and Erin Swinland. For those of you joining us for the first time today, welcome to the show, and for our regulars, welcome back. Well, today, a little different than yesterday. We'll talk about a number of things this morning, but first, the Dow Jones Industrial Average currently down 415 points, the S&P 500 down 33, the NASDAQ down over 100 points, down 108. The Russell 2000 hanging in, down only 5 points today, actually performing much better than the other indices. 10-year Treasury yield, this is pretty big news. It just continues to drop, suggesting the money continues to rotate into the defensive Treasury market, and the TNX now down to 2.58%. I cannot believe how far it's dropped. Volatility index is up today about 6%, but really not much considering all the selling that's taken place today and the news that was out yesterday after the bell. We'll talk more about that in a bit, but volatility is back on the rise. Real estate, one of the defensive sectors, outperforming. It is higher today, up 44 cents, 1.4%. Consumer staples also in the green, along with utilities. So the three defensive groups leading to the upside, very similar to the defensive money heading into the Treasury market. After the bell yesterday, the biggest news yesterday wasn't while the market was open. It was after the market closed. Apple came out. They were halted after trading, finished for the day, and they dropped a bomb on the market, suggesting that their upcoming quarterly revenues would fall well short of expectations. We're going to look at that chart in a minute, but you can see Apple down more than 8% today, $13, back down at a new low. So those recent gains that we saw evaporated with the news after the bell yesterday. Bristol Myers agreed to acquire Celgene Corp for $50 in cash, plus one share of Bristol Myers. And you can see that Bristol Myers being the acquirer, traders fearful of the dilutive effect of an acquisition this size. The stock is down quite a bit. You can see the positive response on the Celgene side. Stock was trading down at 67. Ironically, it was down in the 50s just a few days ago, maybe a week ago. And now they've got an offer for $50 in cash plus one share of Bristol Myers. All right, Erin, I tell you, from the time we left yesterday where the market was rallying and looked like, after we gapped down, we were going to rally back and have and we did actually finish pretty strong yesterday. A lot changed since then with the Apple news that came out yesterday. And I think, the market has priced a lot of this in. We've seen a huge drop in the market. And so as technicians, we see the news a lot of times hitting after we've seen the damage on the charts. And that's exactly what we saw with Apple last night.
Absolutely. Totally agree. I'm watching, of course, the market here on my side computer. And it looks like we are coming back up just a hair. I think we were down over 2% earlier. Now Dow's only down about almost a little over 0.75%. But yeah, at this point, as I my mantra continues to be on Market Watchers is whenever we see any of that strength, if you're still in, I think that's the time to get out. So yesterday when we started to see that strength at the end of the day, that would have been the time. So keep an eye out on those types of opportunities if you are still sitting on some of your longer term investments. I don't think I'd want to hold on to them at this point. So
I think that's a good suggestion. Also, the one Wall Street adage that I think will probably live on forever is that the stock market, when you look at it a lot of times, it's either a buy or a sell on rumor, and it's a buy or sell on the news. And in this case, we've seen the market be selling off and selling off and selling off. And I know I look at it and I'm like, wow, I don't know exactly what message this is sending, but it's not a good one when you see the market getting hit the way it got hit in December. Now we're beginning to see some of the news that's coming out. So technicals are so important to follow. And Bruce, I know we got Bruce Fraser on here today. Welcome to the show. Welcome back. And I know, from a Wyckoffean approach, you look at the data or in the charts, not the fundamental data, but the price data. And you have to make assessments from time to time. And it's really no different looking at the market or looking at an individual stock. It's been, we've been getting messages that there's problems out there, and we're starting to see some of the news now. Would you agree?
Oh, absolutely. And that's the beauty of the markets. Is the reason we have to be technicians is because the market discounts the future. It looks ahead. It sees things coming. And when the market persistently starts to drop like this, you know that and you said it, Tom, you know that there's news out there. And there's something happening, and we're going to find out. And when we get the news, it's largely already been discounted in the price. So this is the reason we're technicians.
Absolutely. And I'm looking forward to your presentation today. I'm always looking forward to your presentation, but I'm guessing that with all the recent selling that we've seen, maybe at some point during today, and you're going to stick around with us during the whole show, which is awesome, and thank you for that. But I'm assuming you're probably going to give us some targets maybe that we'll be looking for on the S&P or the major indices.
Yes, absolutely. And we've actually hit a few targets.
Oh, okay.
Yeah, so that could be maybe some good news.
All right, so we got the carrots out there. We're hanging the carrots right now for everybody to stick around so that you can go over all this information. Stick around, though, Bruce, because we're going to bring you back in about 15 minutes or so. Looking forward to it.
All right.
All right, Erin, what do we got?
All right, upcoming schedule. Tomorrow we have Mary Ellen McGonigal. She'll be in for me and doing the What's Hot, What's Not with Tom. Greg Schnell's going to be with us next week on Wednesday. And then Greg Morris will be with us on Thursday. So looking forward to that. That'll be great time. Today's agenda, however, Risky Business in 2019. That's the title of Bruce's presentation. 10 in 10, we're going to do Hain Celestial Group first, HAIN, and then Are You Buying This? And that will be a very interesting segment with all three of us giving our opinion on a particular topic, of which we will dangle another carrot out there for you. So, all right, with that, let's go ahead and move on into the technical news and headlines. I know there were a ton of economic reports today.
Yeah, we had a bunch, and I tell you what, they were very confused. Well, not confusing, but just mixed. You can see right there on the top, December ADP employment report. Huge report, 271,000 versus 175. Initial jobless claims, though, was higher than expected, 231,000 versus 217,000. The December ISM manufacturing index came in much weaker than expected, 54.1 versus 57.9. And then finally at 10 o'clock, November construction spending was due out with an estimate of a rise of 0.2%. But this report actually was subject to the government shutdown. So we are not getting that report today on construction spending, but that was the estimate. And when I look at these reports, I mean, that employment report is huge, but when the market is in bear market mode, it tends to just ignore good news and it focuses on the bad news. And we had some of that out this morning with the initial jobless claims, the ISM manufacturing index for December, and of course, the Apple warning yesterday after the bell. So that's what the market has chosen to focus on today, not the jobs report. And it'll be interesting to see whether or not this huge beat in the ADP employment report is a precursor to a big beat tomorrow on the non-farm payrolls. Sometimes these go opposite directions. So that'll be an interesting report to watch tomorrow morning. Okay, so let's take a look at the 10-year Treasury yield. And this, like I said, the market forecasts ahead, not necessarily what happened last month, but what the market is looking at coming up in the next few months. And what I'm seeing here on the 10-year Treasury yield chart is not good. There is just no reason. There's no, I can't come up with a bullish argument why we would see the 10-year Treasury yield drop from 3.25% down to 2.56%, which is what it hit earlier today. In less than 2 months. There's really no bullish argument for that. The Treasury market is forecasting a big slowdown ahead in terms of economic activity. And so I think we should be preparing ourselves for that. And when you look at this and compare it to, say, the S&P 500, S&P 500 was dropping, but you see the bounce here in the S&P? We're not seeing that in the bond market. So Treasury yields continue to drop, meaning money continues going into the Treasury market. And if that continues, there's no rotation out of the Treasury market to help fuel a stock market rise. So that's one of the big problems right now is, yes, we got a nice little pop, Santa Claus rally, whatever you want to call it. We're beginning to roll back over. We've got some overhead issues. And if the money's not coming out of the Treasury market, I don't see enough money coming in to take out some key resistance levels. So short term, it's kind of confusing, I'll be honest, because when we do look at the volatility index, we hit such a high level a little over a week ago, back in the mid 30s. When we tend to mark significant bottoms when we get that kind of volatility reading. So I do think that initial move on the S&P 500 to the downside is going to be a fairly important, well, it's not going to be fairly important. I think it's going to be a pretty key support level as we pull back. If we get back down there, I think it holds. I think it sets up maybe for a little bit more consolidation, and then perhaps we go lower later in the first quarter, maybe into the second quarter. That's what I would assume based on what I'm seeing here on the charts. But again, it's going to be, day to day. Let's see what's going on. Let's watch it closely and kind of take a look and go from there. Apple was the big news after the bell yesterday. They did lower their upcoming quarterly revenue target. I think the market was looking for about $91 billion. Apple had previously forecast 89 to 93, and now they're saying 84. This is the first time that they have lowered their revenue forecast in almost 17 years. 2002 was the last time. So this is big news. Apple normally is one of those companies that we can rely on. They tend to be very conservative in their forecasts. So when they miss, I think the market really takes notice. So Apple down today more than 8%. If there's a piece of good news here with Apple, is that as it breaks down, it's trying to recover off of its earlier lows. And with a lower price, we have a higher PPO. So perhaps short term, especially if we finish pretty strong today at the current price or higher, I think maybe, just maybe, Apple will have put in a short-term bottom and maybe rally back up toward the 20-day moving average. We'll see. Getting into some of the other stocks affected by Apple, because you got a lot of suppliers out there. QRVO, which is Corvo. You can see as I go through this list, all of them are having a tough day today, as you would expect with that kind of news. But if you notice, many of them, if not all of them, have been in a pretty long downtrend. So once again, it's a rumor that's already out there. Of course, Broadcom has been performing pretty well. But most of these you're going to see have been moving lower, heading into these, into the Apple shortfall that was announced yesterday here. STM Microelectronics breaking down below a triple bottom. QCOM, which is Qualcomm. Not too long ago, this stock was looking pretty good technically and fundamentally, talking about buybacks and things like that. That was a long time ago, 3 or 4 months ago. Now it's about fundamentals, and clearly Qualcomm is not looking very good. NVIDIA, remember NVIDIA lowered their guidance back in November. That's what was, we saw with this drop. After we rallied one time to test the 20-day, it's continued moving lower. This isn't just a one-time story, in my opinion. I think this is something that's likely to be with us for quite a while. Applied Materials, a semiconductor equipment company, also going down the news, but this is a stock that literally lost half of its market cap since earlier in 2018, and as a result, didn't take the news quite as badly, still holding up above the recent lows. A lot of it, I would say, already priced in for Applied Materials. Another semi that did lower guidance in mid-December, this was Micron, and you can see Micron, after moving down, came back up, tested that 20-day moving average, and starting to roll back over again. So that seems to be the theme as far as many of these technology companies go. One other semiconductor, I think this was talked about in the 10 in 10 yesterday, AMD getting up close to that 20-day moving average yesterday. Look at what it's doing today. So, instead of thinking about buying on pullbacks to the 20-day moving average like we saw back during the bull market, now we should be thinking the opposite. We should be thinking about selling on tests of the declining 20-day moving average. All right, last thing, Erin, I mentioned this yesterday right before I turned it over to you for upgrades, downgrades. A quick update on the high market cap companies. Microsoft, $756 billion, Amazon, $745, Google, $717, and Apple, with the big drop today, now down to $684 billion. Market telling us something.
Oh, my goodness. Yeah, and I did on the 2018 review, I did it on the FANG stocks, and, they had lost almost $1 trillion in value since the top of in October. So pretty ugly right now. And yeah, I would say that it certainly is telling us something. So let's go ahead and look at some of these upgrades and downgrades, though. I do have quite a few. And today I have to say this is an excellent day to get information on support and resistance. So I'm really going to concentrate on that, on these upgrades and downgrades, because wow, it's just a really great introduction or refresher for everybody on how to find some support and resistance. So first of all, we're going to look at Anthem. Anthem was upgraded today by Evercore from an inline to an outperform. And so what I did is I look at, the recent, what looks like support, and I look for a level that's psychologically maybe important at, like a mark, an even number as far as the price. So I had that, and I went back to kind of look at where we had some interesting areas of possible previous resistance and support. And what I did is I came back here and I actually took one of the lows in price back here, and I was able to match it up with that 245 level. And notice that comes in for, you've got some resistance back here in May and June. And you also can see back in January that there was a little bit of support on this tiny consolidation zone. So I think it's real important to, of course, understand these. And right now, of course, we can see Anthem is coming down to test that support level at 245. The PMO is pretty ugly. It is turned down and is continuing to move lower below its signal line. And as you can see, we're not looking at some really good volume activity here, but the scooter's still fairly healthy, I would say. And we're getting that PMO into very oversold territory. This will be the place at 245 to watch. If we're going to get a bounce, and this is in that defensive healthcare sector, that's where I'm going to look for it, because we do have a lot of touches at that 245 level. All right, Gilead Sciences was upgraded today by Oppenheimer from a market perform to an outperform. And this one was excellent to find some support and resistance levels. And again, it came down to looking at earlier short-term levels of support and or resistance. And I found this area right in here at about 65. And so I went back again, started to look at other areas where this could be lining up. And not only did we have these short-term lows, but you can also see we had some lows here on this consolidation zone back in May. And then look at this resistance level. This level has 1 million touches. Well, not 1 million. It has 9 that I came up with, which means it's it's very, very strong. You would look at this as very strong resistance. So what I'm looking for as far as what we're looking at Gilead Sciences, I think this looks pretty good. You got a gap up to that area of what was resistance and now could be forming support. And you have a pretty nice little trading channel. And so this one could be worth the ride up to test that resistance. I'm not looking for it to break out above that, but maybe I'll change my mind if I were to look at this chart later, because we do have a PMO buy signal coming in. So I think this could be a really interesting play. Again, in the healthcare, Gilead, I believe, is a biotech. All right, Google Alphabet was upgraded today by Canaccord from a hold to a buy, and they moved their target from 1140 up to 1250. So, pretty interesting on the upgrade. Tom and I were talking about it, that this, of the FANG stocks, this one's probably the most healthy, have a nice positive divergence going on here with the rising bottoms on the PMO, declining bottoms on price. I would expect to see it move up higher. I would say the next area to watch is going to be this declining tops trend line. I'd want to see it get back above that. Right now, the 5-day EMA is just turned down below the 20, not really good news in the short term. All right, let's look at a few downgrades here. Apple, we've talked about quite a bit here, but let me give you my 2 cents. I found some support here at about, looks like 146, 147, matches up back here to that February low. You can see that we gapped down and are now trading below that area of what was short-term and longer-term support. Not good news. And of course, we had what I would call a bear kiss, came up, got the fake out that we were going to get that rally. And now today on that gap down, PMO has turned right back down. It is an oversold territory, but we're seeing a lot of stocks in oversold territory. And oversold in a bear market doesn't automatically mean opportunity. It means thin ice. You might be able to get a little bit of a leap off of it, but I wouldn't count on it as being very strong. All right, so here's the Apple weekly chart, and I think 140 is the level as far as the next level of support goes, 140. And then after that, I would start looking at where we had these highs back in 2015, which has dropped to 125. And I think that's very likely, is that drop to 125. Not so sure you can get a lot of shorts on that one, though, but who knows? All right, American Electric Power was also downgraded from a buy to a neutral. And, you know, at this point, it's holding the support level about $73. But the PMO looks pretty ugly. It's now hitting negative territory. It's far from being oversold. I would stay away from this one, even though it is in that utilities sector, that more defensive area. CBRE Group, I thought this was a very interesting chart, again, because you can see these support and resistance lines and how many times we get these touches. It's fascinating. And, you know, it's not just a technical, you know, we're looking at the chart and we're seeing it. It is sort of a mental stop there. I mean, people recognize psychologically all of those levels. And so you can keep that in mind. Right back here is where I started, where those closes were back in February, those lows. And I hit that and it came through, and notice it touched here, touched there, it touched here with the overhead resistance. So a very strong area of resistance, I would say, at those levels. And I think that was it. Yes. So here is the list of upgrades and downgrades. A couple of extra ones we didn't go over. Canadian Goose, Cintas, Dish, First Solar, Honeywell, Illumin, Insight, Sunoco, Teva, and Cigna all were upgraded today. And other downgrades, AbbVie, Albemarle Laboratory Corp of America, LH, Lumber Liquidators, and finally Quest Diagnostics. So we had quite a bit come in on the upgrade downgrade list. Whew, sorry about that, Bruce. I kind of cut into your time a little bit, but let's bring you back in. I think it's always good to give people that refresher on the, as I call them, the building blocks of technical analysis.
I'd much rather listen to you than listen to me. So.
Oh, well, I have to say I disagree.
Anyway, okay, well, here we go. Let's see if I can, there we go. See, can you see my screen okay?
I absolutely can, thank you.
All right, well, it's so great to be here. Happy New Year to everybody. And I know we sort of had a Wreck-It Ralph fourth quarter, and it's been painful, and we're just gonna work on stuff and get it right. So risky business 2019, and I'm going to sort of talk about some of the things that I've learned as in this business. I've had phenomenal mentors, and these mentors have taught me so much about portfolio management, which I did as a career for many years. Have taught me so much about business cycles and model building and tactics and strategy. And so I just want to just get into that, because I think that if we follow some simple, basic, common sense rules in portfolio management, we can do a lot to reduce our risk, stay involved in the markets, and then be in a position to really benefit when the markets are ready to become generous again. Right now, the markets are stingy. And so we want to be there, have our powder dry, be ready to go when the markets are ready to be abundant. So here we go. So first of all, just want to let you all know about a series that Roman Bogomazov and I do, which is the Wyckoff Market Discussions. We do them on Wednesdays at 3 p.m. It's a Wyckoff-based last bar analysis where we focus on best practices in Wyckoff, better trade selection, better trade entry, better campaign strategies, trade mastery, and so on. We just did one yesterday. The first one of the year is always free, and we have a special going at this time, and you can listen to the recording. And so if you will go to this email address, Wyckoff Associates, you'll be able to see the or go in and request that recording. So anyway, have a look at that, check it out. And here's also some free content on Wyckoff that you can look at if you go to the website, which is wyckoffanalytics.com. And so there's a lot there that you can read about Wyckoff. And then also, we have a technical society. This is the TSAASF. It's the oldest technical society in the country. It's all volunteer, not for profit. We're totally focused on improving our skills in technical analysis through study, through courses, through speakers. And our first speaker of the year is actually one of my most important teachers. And he is Joe Turner. I've known him forever. He's a very dear friend of mine. He and I are going to have a discussion on January 10th in a webinar setting. And he is going to talk about the 2019 forecast that they have at Pring Turner Capital Group. His partner is Martin Pring, another one of my mentors. And so Joe's going to introduce a look at the 2019 markets from his business cycle perspective. And then also this will be followed up with a part 2 in February, where Martin and Joe together are going to do part 2 of this analysis. And it's just a must see event. And you can go to tsaasf.org to sign up for the first part. The second part, you have to be a member, but it's really a very inexpensive proposition to be a member of the TSAA, $75 a year. And again, it's all volunteer. It's a different kind of an organization, but very much focused on technical analysis. And so check it out. So, and I hope to see you there on the 10th. Okay, so here we are managing risky markets. And really there's some key steps that we can follow to be able to systematically protect our portfolios, protect capital, and continue on in the game. The problem is in investing is that when markets become like they are now, where they're in a general downtrend, there's price destruction, oftentimes people become discouraged. We as a group, we as technicians want to stay focused, committed to the markets, bull and bear side of the business cycle. And so there's a way for us to do this. There's a way for us to adjust our tactics in our portfolios. Now, admittedly, many of you are swing traders and many of you are short-term traders. And understandably, the tactics would be different. But I think that there's some ideas here that could be of service to you. So the first thing, obviously, is to protect capital. And so this is very important. And so everything that follows is really about supporting that main thing, which is to keep your capital whole so that when the markets become generous again, you're in a position to really take advantage of that. We all are in a position to take advantage of it. Keep your market focus. This is one of the most important things that I can recommend, is that even though the markets become like less fun, they're just not producing the returns that we would expect, we still need to do our work. We still need to be there every day, do our studies, be prepared for that moment in time when the turn comes. And so let's always keep our market focused, stay, in your stockcharts.com account, looking at your key indicators and your stocks every day. And of course, we always want to do this, which is to use stops, but we want to also be more judicious about when we trade and have our stops closer to where we're putting our entries in. And also we want to trade less. So we want to undertrade. And so we want to be much more careful about when we enter into the market, because if you're in a good, vibrant uptrend, if we don't get our entry quite right, the uptrend will bail us out. But in a downtrend, especially if you're trading long, you want to trade less. But the other thing is that you want to under trade and reduce your position size, because you do not have an uptrend to bail you out if you get your entry wrong. And so and you want to keep your stops tight, because the number one goal is to protect capital. And so be more careful, trade less, recognize that you have a hostile environment that you're working in, reduce your position sizes. I think that reducing position size is really important, because you know, subconsciously, whether or not we're trading much larger or we're trading much smaller, maybe we're just trading 100 shares. The thing is that when we make that trade, we're engaged, we're committed, we're involved. And so it doesn't matter whether it's a small position or a large position. At a level, we want that to work out. We want to demonstrate that we still have our skill sets, we're still developing mastery. And so small position sizes still have a really profound impact on our psychology when we're trading. And so this allows us to be able to be participating, but at the same time, not putting ourselves in a position where we can really harm our portfolios.
Hey, Bruce.
Sure.
I was just going to comment there on that list that you had. If you go back that one slide,
Yep.
First of all, I think this is a great list. The only thing that I had a couple questions as I looked at it.
Sure.
And number one, and we talked about this before the show, keeping your market focus. And I think when you get into bear markets at first, when you first start to feel the effects of a bear market, you're still in that bull market mode and you're thinking, okay, well, prices are just getting cheaper. This is getting better and better, when in fact it's getting worse and worse. So there are, certainly some clues that we have to look for to see that the trend has changed. And I thought your comment about an uptrend bailing you out when you have a bad entry point, I think that happens a lot in bull markets. And so I think, when you switch to a bear market, you're right. Everything for the most part is going down, and all of a sudden you don't have that rising tide to lift up that boat, that stock that you just bought at the wrong time. So I thought that was a really good point. And as you get deeper into a bear market, I think the tendency is for people to stop looking at their statements, especially if they're holding stocks long term and they're just like, okay, I'm in it for the long term, I'm not even going to look at it. And that maybe there's a case to some extent for doing that. I mean, obviously you don't want to miss out if the market rallies and all of a sudden you made a bad timing on getting out. But that's something that I think everyone struggles with, or most everyone struggles with in a bear market. Now, as far as the stops go, you talked about using stops and keeping them tighter. Do you use intraday or closing stops? Do you wait to see where a stock's going to close, or do you simply have an intraday stop, and if it gets taken out, you're gone?
Intraday. I just put the stop in. I pick a point. If the stock or the instrument gets to this place, I'm wrong, and I'll just let it stop out, and then just start over. I may reanalyze, go back, trade again if I think that there's a reason to do so. Otherwise, I just move on.
Yeah, and I think. Well, go ahead.
No.
I was just going to say, I think the intraday stops are good anytime, but I think the point that you made about being in a downtrending market, if you don't have your stops in play, then you're subject to that stock. I mean, think back to 2000, 2001, all those technology companies. If you owned any of those back then and you had an 8% stop or a 5% stop or whatever, think of the money you would have saved during that bear market. Same thing applies today.
Absolutely. And any stop is better than no stop. So,
yes.
It's just, I think it's like, try to be sharper about entries, be more willing to pass up trades, recognize that the market will move very volatilely. Short covering rallies can be just wicked in their lift, in their rise, and people that tend to get short will get caught in those. But also people will try to trade them on the upside. And short covering rallies, they happen very fast. The best part of the move is at the beginning, and they stop suddenly, and all of a sudden they're turned and they're going back down again. And so just keep those stops tight, move them up, and recognize that bear markets are really designed to psychologically discourage and diminish us in the markets.
Can I ask you one more question about
Of course.
That?
Yeah.
Okay, so when we get into a market like this, I like to trade individual stocks, but I'm not saying I won't trade individual stocks, but I have now moved more to ETFs just because if I get something wrong, it doesn't move as fast in going against me. Do you use ETFs at all, or is this strictly how you're trading individual stocks as you move forward?
I love to trade individual stocks, but typically what I'll do is when I become seriously interested in a theme, industry group theme, or the market, a sector, I'll step in with a purchase of a sector fund or an industry group fund initially, and then I'll pick best stocks and attempt to go to the leadership and trade those stocks in that group. But my first step will be to buy the ETF.
Okay. Because I know for me, when I look at the market, especially when I look at a bear market, I think of a much more emotional market, one that's not really rational sometimes in how it values companies. And I mean, we saw that a little bit with Apple. I mean, everyone's arguing now, is Apple, is this the bottom? Should we be buying, 4 months ago, it was $230 and now it's, $144. And so there's an emotional component to a bear market that I think is eliminated a little bit when you get into the ETFs versus the individual stocks. And the other thing, when I look at the market now, is I try to trade a little bit more off of sentiment indicators like the VIX or the put call ratio, as opposed to anything fundamental, because I keep my strong earnings and weak earnings chart lists. And that's the way I tend to trade, is off those individual companies. But so much of this market now is emotional and it's not based on the fundamentals. And so I don't know if that plays an impact in your trading as well. Do you look at those sentiment indicators at all?
Yes, as a matter of fact, I sort of have one today that I'm going to briefly go into, and people can study it further on their own. But I think that what you're saying my terminology would be that you're being very opportunistic and defensive in your trading in a down market by using those indicators. You're really being sharp on your precision about where you go in, and you're using these sentiment indicators to do that. And I think that makes all kinds of sense to do that.
Yeah, and I'm trying to eliminate a lot of the individual stock risk as well by getting into the ETFs. I mean, obviously ETFs are a basket of stocks, but one stock, if you're buying and selling individual stocks, one stock can really hurt your portfolio. But if in an ETF where you have a basket, one stock is not going to have nearly as much impact, similar to what Apple's doing today, say to the S&P or to QQ.
For instance, I use the term base failure. And so you'll see these seeming bases that show up in these individual stocks, and it'll jump out of the base and then fail. And that's a very common thing to happen in a bear market, is base failures. And so they'll make you crazy. And actually that can be a great short selling tactic, is to look for base failures if a person is so inclined to sell short, which I'll do a little bit, but I don't do it much. I'd rather just be in cash and just be patient and wait for another opportunistic moment.
Okay. Appreciate you taking the time and letting me throw those questions in there.
Well, here's some other things that we can look at. For instance, here, and this is right from my mentor, Joe Turner. This is one of the things he taught me many, many, many years ago, and we did systematically in portfolios. And so think about these as being sort of a framework. Raise cash when the markets turn from up to down. Raise cash. That's a form of asset allocation, but cash has zero volatility. So go to money markets. Raise quality. Choose stocks that are in the top 2, 3, 4 rating categories for financial safety. And so you could go to like a Value Line Service or Morningstar or other places, and you can see that they have a financial safety rating. So raise the quality of your portfolio. And also, if you're a trader, a swing trader, trade quality, raise the quality of the stocks you trade, because those are the stocks that institutions will go to first when the market starts to rally, even if it's a bear market rally. They go to quality, and then they work their way down into the more speculative growth names later. So there's tactical reasons to go to quality. Raise income. So these are all things that are going to reduce volatility in the portfolio. Raise income. So seek stocks that have good dividends, and this is important, and this is the reason you need quality, good dividends that they have the cash flow to pay. You don't want to buy stock in companies that have good dividends, but they don't have the cash flow to be able to pay the dividend. And so those will tend to be lower financial quality stocks. The other thing is to raise value. Look for stocks that have really good demonstrable value in their structure, in their balance sheet. And you can see all of that by going to, say, Value Line or Morningstar, et cetera. And then asset allocate. So asset allocation can mean owning more bonds. And so you can see how the bonds are rallying here. This is a great place to be. An asset allocation move might be to own some gold shares, which are acting much better than the market is. Things like that. And so there are ways you can asset allocate to reduce volatility in your portfolio. And so I would just consider those as being things that you should generally do throughout your portfolio when you get into a hostile environment. Okay, so let's move on. All right, now I'm going to go through these really pretty fast because I know that I have a limited amount of time, and you guys are just going to have to drag me off when the time's right. So here you can see that this is a blog that I wrote December 10th, yield curve inversion, and all I want to point out is this point and figure chart, and this point and figure chart had a count that goes to this 103, 62, 104, 28 level, and we've already gone there. Tom pointed out yesterday and today how quickly the bond market has rallied to that level. Well, there's more fuel in the tank, and so there's this possible 106.59, 107.25 level. Now, my view is that if we keep going and go up to this level, it's because things are bad in the market, which is a point that Tom and Erin made earlier. And so the continued rally in the bond market, which is an important allocation for us to be defensive, if this doesn't stall here and go sideways for a while and keeps going up to this higher level, it's because the market's not doing well. So anyway, here's that yield curve. I'm not going to go into this. We don't have time, but I just want to point out that there was this big panic about the yield curve going negative. And the yield, and this is a cool chart that Stock Charts has for us. So jot down this symbol, is that, and I drew a trend channel, and you can see how well it stayed in the confines of this trend channel all the way down for a very long time. This is the beginning of 2017. So, but the key here is that yield curve inversion is a problem because interest rates are rising. But here you can see that interest rates are falling. And the yield curve is sort of near this zero bound, but rates falling, I think, really makes this whole yield curve argument not important. And so the key thing we want to focus on is that interest rates are falling. This is something I want to talk about as just being for us to be opportunistic. And so if you look at these trend lines, this is a 5-minute point and figure chart, covers about a month, a little over a month, 3-box reversal. So we can take counts here. And the thing is, look what happens when we climax on this point and figure chart. So this really well-defined downtrend line, it climaxes that trend line and then turns off of that and turns up back through it. That's what I mean by opportunistic. Because when you see this kind of thing happen, you can place your trade, put your stop very close, and then be able to see a market run up and then evaluate whether or not this market is one that has legs and can keep going. So you initially have a good start to your trade. This is that area where we had that big 1,000-point up move all of a sudden, and that's the way these moves happen, is they jump very quickly. This is a chart that I do want to spend some time on because I think this is a really important chart. This is the New York Stock Exchange percent of stocks above their 200-day moving average. And the notion here is just very simply that when a stock is above its 200-day moving average, it's by definition, we say it's in an uptrend. When it's below, the price is below its 200-day moving average, we say it's in a downtrend. So this takes the aggregate of all the stocks. In this case, it's all the stocks on the New York Stock Exchange. And it looks at that and says, what's the percentage that's above its 200-day? And so what we want to see in a bull market is we want to see the stocks really above this 50 level. And when it gets below the 50 level, the logic tells us that when you have like 20, 30, 40% of the stocks in uptrends, that the stock market, the majority of stocks are trying to go down. They're below their 200-day. That makes the market heavy, makes the market dangerous. And so you can see here that when the market is dropping below this area, this 50% level is where the real trouble starts. And so, but what I want to focus on here, and I want you to go back and reconstruct this chart and look at it, go through history. This is the 08-09 period. I think that there's a parallel here to where we are right now, potentially, because you can see where we were in 08 right there. And you can see where we are right now, where we got down to like 12%, 12% of stocks above their 200-day. Very low, but it can even get lower. But the key is we can see that once you hit a level, you tend to rally and then test it. And in this case, notice how this is a low and a higher low. And here is a low and a lower low right there. And this is in the downtrend of 08. This could be an analog to what we're in. I think being in the new year, that the selling that's been going on may stop and produce some kind of a vacuum where the market can have a rally of sorts. You can see that this is a rally that came, look at the divergence. So higher low here on the test, lower low in the index, and then a rally. And we should be able to count this area in a point and figure chart and get an estimate for how much fuel it creates for a rally. This is a quarter of a year. If you're a short seller, you do not want to be short over a quarter of a year, even if it's a bear market environment. And so this is something for everybody to be really focused on. And so you can see that this rally went above 50% here and then turned around and came back down. This got down to 3% at the end of 08 in that 3% area. But look what happened. Lower low, this is November, down to, I think, March. Lower low, higher low in this index. This means that there are more stocks trying to get above and stay above their 200-day moving average at the March low, which is a positive divergence. And look what it led to. This is the liftoff of this new bull market. It was dramatic, got almost to 100%, went over 90%. So here you can see, I'm not going to go into these other ones, but same thing, lower, low, lower, low, divergence, low, lower, low, somewhat of a divergence, a little bit lower here, but still constructive. And this low right here was higher on a lower S&P reading. Now look at this. Here's a high and a higher high and a test that occurred in 2018. Look at the extent of the divergence here. Huge divergence. And then it just led to a complete breakdown. So I'm thinking that we can look at this 08 period as a possible bear analog, and then we can look for the potential for a rally and a divergence for a bull analog. But in either case, we need to see some kind of base building, cause building that we can use to do point figure analysis. Speaking of point figure analysis, here's the cues. Here's the count off the top that this is a one box reversal. This is a swing trading type of a trading setup here. This yellow shaded area represents the area of that count above. We can see that this counted to 146, 138, which was a substantial decline. And we were still in this trading area here. Well, look what happened. We've just gone down into this 146, 138 area. We became oversold below the trend channel line. This is a climactic decline, which is terminal, at least momentarily terminal, into a point and figure count objective, and then we get a bounce. So this is a really good count. We may just get a trading range here for a period of time, but we're going to see whether or not we can build a count for an accumulation or for distribution. But it appears that this climax, oversold, point and figure, it's like a trifecta, that we have all these things together that have congealed to produce, I believe, some kind of a trading range for some period of time into the new quarter. You guys are just going to have to like drag me off the stage when the time is right. So, because I could go on and on and on.
Of course, of course. Yeah, we're getting near the end, but so if you want to sort of wrap it up, but I don't have any questions yet in the chat room. So,
well, that could be a bad thing.
No, I think you're being that clear about what
you're talking about. So
if you want to wrap that up, then yeah, that'll work.
This is a chart that I put in the last blog, and you can see here that this is a beautiful accumulation, reducing, there's a reduction of volatility. This is a sign of absorption, which produces a point and figure count, which gives us a count for higher prices. This is the January peak, February low, which we've evaluated in a number of blogs through the year, and it produced this move up. I'm going to show you these counts in a minute. And now we have two distribution counts. This is a NASDAQ comp. Small count, big count in these shaded areas. And then, boom, we get this big breakdown. Well, so let's look and see if the point and figure charts. Now, notice this, same thing as the Qs. Becomes oversold, goes down through the bottom of the trend channel, and then comes back up into it in a pretty abrupt way. Look, PNF objectives reach. Well, let's look at these PNF objectives and see what we get. So anyway, here it is. This is a count we took early in the year right here. And you can see that, look how well this count worked. Oh my gosh. It counts right up to the highs. We get a climactic push, a test of the climactic push. And then this completes the minor point and figure count, takes us down to the 7350 area. Well, this turned out to be a trading area. And then after that, there's a bigger count, and this bigger count takes us down to here. Well, we're now in this area right now. And so the point and figure work suggests that we have, and we're at a key support level. This is the support level from this area right here. And so this key support area has also produced the condition for a bounce, potentially. And so I think that this could stop the decline for a little bit. Last one, I think I'll use this later. So anyway, and then I think this is a good place to stop. The only other chart I have that I want to show you, which is one we've looked at in the past, and you can go to these blogs to look at these charts. This is a chart I published in 2016 that said that the Apple had a huge move ahead of it, but I want to just show you. This is the that's the FANG one here. Apple made a nice little top, And so it made a nice top, trading top, one box reversal method. Can't take account. Look here. We fulfilled our count from 2015, 2016, and a reaccumulation count. They both counted right to the high. Oh my gosh, look at that. So they counted right to the high, and look at the change of character that came as a result of going to that count. We've looked at this chart before, but now we get a distribution count. And this is why we always want to wait for a cause to build, a bull cause or a bear cause. We don't want to be too early. And here, Apple was saying, I'm distributing to go down. I'm going to go down. And look what it did. It went down. It was a big count, counted 172, 146. And then what I do is take the midpoint at 159. You can see it climaxed right into this area, attempted to rally, and now it's gone slightly below it. I'll be very curious on, because this is on news now. So usually it's what Tom said earlier about when the news comes out, it's usually later in the move. It's the reason the move happened. And so now we have this news today on Apple. I'll be very curious whether Apple can get back above this 146 level of this lower bound of this point and figure count. And then it needs to build a cause.
Yeah, I think actually, Bruce, on that Apple, I think that was exactly what Erin was pointing out when she had that downgrade, was that she had that longer term support area right around 146. So it gapped below that, and of course went down earlier. Big volume today. So I do think the close is important. And if we can get back up closer to that 146 level, I think maybe we could argue that a lot of the news was built in. You know, this is kind of like a final selling episode, at least in the short term, and then we'll go from there. But
well, thank you. We'll leave it there because I always have more than I can do. So anyway,
and we appreciate it.
Happy to, enjoyed it, and
yes.
I'll stick around. I'll be around.
Yeah, and I just want to mention one more time. You have your friend next. It's next Thursday, right? January 10th.
Joe Turner.
Yes.
And we will continue this discussion. He is one of the most brilliant business cycle model builders there are. Between him and Martin, they are just brilliant together. And and tremendous experience in the markets, 50 years. I didn't put that in there probably, but Joe has 50 years in the industry.
Wow. Yeah, it's always better to have experience, especially when you get into a market like this one, because these don't come around very often.
Yeah, and it's good to have somebody who's seen them before, and seen a lot of them.
Yeah, I've seen them, and some of them I wish I hadn't seen.
Yeah, me too.
Anyhow, so where do they go if they want to sign up for this to be part of this next Thursday? Website
tsaasf.org.
Okay.
Yeah. So let me just go put the slide back on there, and people can see it. Sorry.
Yeah, this was a great presentation today, especially in light of everything that we're facing in the market.
Absolutely. I know we're going to be talking a lot about bull and bear market rules and the different things you need to do to protect yourself. So I think this was quite timely.
Yes.
Well, thank you. And the key is we all want to be here when this is over so that we can be here for the good times.
Yeah. Now, I try to get from the beginning of a bear market to the end with capital intact. If I can get in with capital intact, think about the purchasing power.
That's just pure genius. If you can do that, and that's got to be all of our goals.
No doubt about it. All right. Well, appreciate that presentation. And also thank you for sticking around, because we got a great segment coming up on Are You Buying This, where the three of us will chime in on the S&P 500 as we go forward. I think it'll be interesting. But let's first get into the 10 in 10. Let's go ahead and get through the 10 in 10, Erin. Then we'll get a quick market update before that final segment.
Absolutely. Go right ahead. Get us started. I will not worry about the RRG. But I have to say, of the 30 requests, 5 of them were for gold mining. So I thought that was especially interesting today. So, but let's go ahead and get started with Hain, Hain.
Well, I tell you what, if I was looking for long candidates, gold and gold mining might be an area I'd be looking at right now. I do think that that's Bruce mentioned it earlier. We've talked about it a lot on the show. This is an area I wasn't a huge fan for a while, but I'm not sure what the dollar is going to do. And I think all of this money moving into safety, we're seeing it in the treasury market. We're seeing it in the different sectors in the U.S. I think that is helping to feed into gold right now. So definitely an area to consider. Let's go ahead and go through these. I did cheat. I got a few of these already annotated so we could try to go through quickly because I wanted Bruce to get through as much of his presentation as possible. But let's start with Hain Celestial Group. You can see the PPO has been declining for quite some time. The stock fell from $26 to $15 in about 6 or 7 weeks. And when a stock falls that fast, what you see is a PPO that declines and gets to a really oversold level. Now, that doesn't mean that I would be racing into it on the long side, because I'll show you some charts in a bit that I think might scare you a little bit on trying to get these oversold dead cat bounces. But Hain has moved back up a little bit off of that recent low. I would be looking for maybe a test at that 20-day moving average, and then I would probably be out of the stock and wait maybe on a double bottom back down here around 15 with a higher PPO. Maybe that would give it a more sustained rally somewhere down the road. But short term, this first initial bounce, the first test of the 20-day since falling with all this volume, I personally would be out of it. So what
all right. The most popular in the chat room, not a surprise, like I said, considering gold mining was the popular of the requests. I'm going to go with AUY as our sample gold mining chart.
Right. Yeah, I like it. I think that this one, first of all, had been downtrending for a while, and I certainly wasn't a fan of gold until recently. But the volume has picked back up to the upside. I think volume trends have turned. You can see that the PPO now is clearly positive after a few attempts. This is as far as we've gotten into positive territory. So I think this is the best momentum we've seen on the stock in quite some time. I think the volume trends are good. I like these pullbacks that are holding the rising 20-day. You can see the green arrows marking those. And now we've gotten a golden cross with the 20 moving up above the 50, which is not really, we've seen a couple of these, but notice the past when we've seen them, we tend to move right back down below the 20. This one seems to be working out a lot better here. So I think the stock's going to make a run. I would say first 270 to 280 in that area. That would not be a shocker at all to me. I would look for AUY to head back in that direction.
All right, excellent. Let's see the next one, Exploration and Production and Canna Corp, ECA.
All right, do not like this one at all. And this is the example I'm going to use why I don't like using crossovers on momentum oscillators in deep oversold territory. Here's a stock that has gone from 13.5 down to $5 in about less than 3 months. That is a huge drop. The PPO is deeply, this is down to a minus 12.5. And what this means, if you're not familiar with the PPO, this is the percentage difference between your 12 period and your 26 period moving average. So your 12-day and your 26-day. 12.5% is a huge number on a percentage basis. And so what that's telling you is that this drop is so steep that it almost can't get any steeper. I guess it could. But a stock going from 13.5 to 5 in less than 3 months, I don't know that the descent can get much steeper than this. So what you tend to see is almost the mathematical certainty of a PPO that'll start to turn higher, even though the price action is selling off. And look at the volume. It's hard to argue that the momentum is slowing down when the price continues moving lower and there's massive volume on the stock. So I think that there are some false signals that you get from momentum oscillators. If I had played either of these positive crossovers to the upside, look at what would have happened in the month of December. I would have gotten trounced. So I think you got to be real careful. Now that we've made the move up, tested the 20-day, I think this goes lower. Again, the first test of the 20. Perhaps if we get back down near the 5, we can establish a double bottom. That might help support the stock for a period of time. But I think that the rally probably is getting close to an end here on ECA.
All right. Great example of a stock in a bear market hits very oversold territory. Oversold does not mean instant opportunity in a bear market or a bear situation. And that's just a perfect example of it. So,
yep.
All right. Next one up. We haven't looked at AT&T in a while, so let's go for it.
All right, AT&T, we did gap down on big volume back in October. Notice when we rallied, we went right to the bottom of gap resistance, failed, and rolled back over, breaking below these prior lows. I think we're moving back up and testing this area again in a bear market where things tend to move lower. I would be a seller into this rally. I think getting back through the 50-day moving average is going to be very difficult. You can see this big red candle here on heavy volume. The selling kicked in around 29.80. Today's high 29.81, the 50-day just above. I don't like it. I would be, if I had to take a position, I'd be on the short side.
All righty. Next one up will be Freeport McMoran. It's non-ferrous metals, so kind of gold mining, but not really. FCX.
Yeah, and what you typically see in a bear market type of a situation, I know, I was not playing this as a bear market till more recently, but this stock has been in bear market mode now for the last several months. In a downtrend, you can see that the PPO in negative territory the entire time. That is essentially what you're going to see in a downtrending stock. So any kind of a rally, I would be a short. The stock failed at the 20-day moving average just recently, began to roll back over. I look for a double test down around, or double bottom, perhaps at least down around the 950 area.
All right. Our only financial request is Square.
Yeah, Square, I was looking at, this is the last one I got annotated in advance, but look at the volume coming in. We did have a support area established from the big gap down, heavy volume, hollow candle, and reversal. And we went right back down on heavy volume and went to below that. Came back up through 56, so that was a little bit of a positive, but could not get through the 20-day, and now starting to roll over again. Once again, I've highlighted the PPO in negative territory. This stock, even though it is in the financial side, it is a high growth stock. And in a bear market, these are the kinds of stocks that get hit the hardest. I would be really careful until we begin to see better technical action. I would be a seller of Square.
All right, let's see. Next one up, we've talked about gold. How about the silver miners ETF, SIL?
All right, SIL, this one's starting to look pretty good to me. I think very similar to perhaps gold, but let's take a look at the area of the resistance. Actually, there we go. So there was the reaction high off the selling that we saw back in August. Went back down to a new low, came back up, couldn't get through, went to another new low, came back up, trying to get through, and now today finally broke above it. I think with the PPO strong, I think this is one. Look at the test of the 20 that held. I think this is acting much more bullish. I think it goes higher.
All right. Next one up, how about Symantec?
Is that SYMC?
Yes, SYMC.
All right, SYMC, I'm not going to be a fan of a lot of these stocks. It did just recently hold on to support in a bear market. I doubt that it lasts. As I mentioned yesterday, one great point that Arthur Hill made recently in one of his blog posts was that when you get into a bear market, you expect support to fail and resistance to hold, which is opposite of what you expect in a bull market. So even though it did hold here temporarily, I suspect that the market goes lower, and I think Symantec fails to hold support. I would not be interested here.
All right. How about X-ray from the healthcare sector, medical supplies?
Yeah, I know some of the medical stocks have been hit really hard. This one is, 67.5 back at the beginning of the year. Now it's 37.5, so that's a pretty good haircut. But I'm not seeing any signs yet that I would be overly interested in getting involved. I think this gets back to what Bruce talked about during his discussion. We need to be patient. We need to be vigilant. We need to be focused, but we need to be patient. This is different than buying pullbacks in a bull market. So I would be just sitting on the sidelines waiting. This is a good long-term company, but clearly the chart still pointing down. A couple of areas of resistance I'd look for just above 40, but I think it's in this trading range probably between 34 and 42 for a while.
All right, and our final one, Ultra Clean Holdings, UCTT.
All right, UCTT, I think that's a semiconductor.
Yes.
I'm guessing it's not looking very good, and it's not. Yeah, I think it's in a channel, oversold bounce that we saw in the market, but notice it came right up to where it broke down from and then turned lower. So we got through the 20-day, which was a good thing. The problem is when you are in a bear market, there are multiple levels that you have to get through. The first one is the 20-day, couldn't get through. Then we had price resistance. Look at the tail above it, failed. Now we're starting to roll back over. The PPO is staying below that center line. We're clearly in a downtrend. I don't like it at this point. I think it goes lower.
Okay, and that is the 10 in 10. Here are the symbols we just went over. I will have these up in the Market Watchers Live chart list. Just go to the blogs tab and click on the Market Watchers Live blog, and you'll find that chart list link right there at the top. All right, time for our final market update. Let's go ahead and see what has been going on. All right, looking okay. Not horrible. I mean, it is pretty horrible, but we did manage to set an intraday low on most of these major indexes, and we did make that move and cut really at this intraday high here at lunchtime, and we did manage to pick up and clean up about half those losses on the day. However, now we're starting to go back down, and we might be looking at another test of the intraday lows. And you can see mid caps doing a little bit better. We almost hit positive territory on that rebound off of the intraday low. We've got Russell 2000, very similar to our major large cap indexes, also starting to pull back, but it also got very close to positive territory. Canadian markets following suit with the US markets made a rebound, and I would expect to see it start trending lower like our large cap indexes. Treasury yields continue to fall. We're looking at 2.582% right now on the 10-year Treasury yield. The VIX is higher, of course. We're looking at a reading just under 25. UUP, the dollar is down on the day, but looks like it may have found its intraday low just above 25.50. Gold, nice big gap up and is continuing higher. Looks like it's about ready to set another intraday high, currently reading 122.10. USO is up slightly. Well, it was up slightly. Now it is no change, currently reading 985. TLT making a move to the upside. Again, not a surprise when you start seeing these yields falling to see the bonds rising. All right, and that concludes that part of the market update. I do want to show everybody a picture of the McClellan oscillator, mainly because I was asked in the chat room. So I'm just going to show it to you very quickly. But basically, they commented on the fact that the summation index is starting to make a move to the upside. And you can see that back here in oversold. But what I would recommend and have you look at is that in a bear market, it's not that great of a deal. We may see even further, we might see lower prices even after that. And again, bear market, oversold, thin ice. All right, Tom, passing it back to you.
All right, I'm going to just pull up the NASDAQ real quick. I just want to show you how this whole price support resistance thing works. We established a pretty big low. This is an hourly chart on the NASDAQ, goes back a month. But we established a low on December 10th. We broke it on the 17th, went back up, retested, came back down, broke that level, moved back up, retested, failed at that 20-day moving average, and then broke down. And this double bottom breakdown that came on the 19th, this whole rally here basically was coming back up to try to test this area. We've started to roll back over again, and now you can see we're below that 20-hour EMA. Came back up and tested it earlier today, starting to roll back over. I don't like the way this thing is setting up right now. If we could get back through 6,700, 6,750 on the NASDAQ, I think that would help to the market to stabilize a little bit more, especially in light of what we just saw from Apple. But I'm guessing we don't see that here. I think we're going to roll back over and go back down and test that 6,200 level. Okay, so now we are going to move into, are you buying this? So Erin and Bruce and I are each going to take turns addressing this statement. And let's see, the statement is the S&P 500 will hit 2,000 before it hits 3,000. Are you buying this? And Erin, I'm going to let you go first. We each have about, I don't know, maybe 3 or 4 minutes to state your argument. What do you think?
All right. I think everybody, as you did when we talked about this before the program, knows what my answer is. I suspect, yes, we will hit 2,000 before we hit 3,000, meaning, we'll have to go down and test that level. One of the things I wanted to point out when I was looking at the very, very long-term chart, this is, 75 years. Yeah, 75 years. What I noticed with the bear markets, and somebody had asked in the in the chat room that, if you have this really long-term bull market, wouldn't you expect to see a very short-lived bear market? And I would have to say no. I mean, look back here from 1995 on up, really very strong long-term bull market. And how long did it take for us to finish it off? Like 3 years coming out of that. So that was a pretty long term. One of the things I also wanted to note when we're looking at these bear market or corrective sort of moves is that what we're tending to see is you lose about half. You're going down in this case from 1600 past 800. In this case, we were at about 1600 and we moved down to 800. Similar situations here. So we're in a bear market. I mean, I totally am behind that. And because of that, I am expecting to see lower prices. Now, I know that there's a question about how low we could go. And I think I've, talked about this quite a bit on the show. And I think we could very easily get down to the 1800 level. And that's because I see that's the next area of really good support. Now, certainly we might find some support here just below 2200, but overall, I mean, I would certainly expect to see us get down here and test that 2000 level. Because if we're going to get up to 3,000, that to me tells me, we're going to be resuming a bull market. I don't see that happening. I mean, we could see a very quick move to the downside, but overall, I think we will definitely hit 2,000 before 3,000. Sorry, guys.
Okay. No problem. Bruce, your turn to weigh in. Do you think we see 2,000 first, or do we see 3,000 first?
Well, let me, okay, so it just so happens I had exactly the right chart in my deck for this discussion. First of all, I do think that we could, I promised to answer this question in my blog. I do think that we have a really good chance of rallying in the first quarter. And I believe that the institutions aggressively sold into the end of the year. They accelerated their selling, especially the FANG stocks, just to get them off their sheets, reduce their exposure, and also for window dressing. And I believe that this produces a situation where we could have some kind of a rally, probably a bear market rally. Now, looking at this chart on the right, this point and figure chart, you can see that I've taken a segment of the total top or distribution area, assuming it's distribution, back to January. And I've taken the first segment, and this count actually takes us down to the area that Erin is discussing, which here it goes 2040. Let's see if I can highlight this. Well, it doesn't matter. 2040, 1780. And so this is the area that this count goes to. You can see what's happened is that we've had a rally, and this rally has taken us right back up to old support, new resistance. And so we're right at a very important place right here where it needs to come back up through here to be able to extend or produce a rally. Maybe it could have a little test and then go through it to be able to have that first quarter rally, because this is a very vulnerable place on this chart. But the fuel in the tank here suggests 2040, 1780 as a segment, a point figure segment. That may be all there is, but this would worry me, because if I know that this count is looming here, then I would expect the market to continue to try to push down to this level over the course of months to the next year. The only other thing I have to say is on the chart on the left, and the point I would make over and over again is got to build a cause, got to build a cause. And that is, look at the cause that was built over here in this base area in 2015, 2016. And you can see here that this area counted across, and I put this count in blogs from that era, from that period. Look at the count, 2960, 3140. we on this upthrust of this area that we're in, it went one box below the bottom range of the count. That's a really good point figure hit. And so right from there, we had a change of character where this market has been basically under distribution for sale, and it's broken down and out of this trading range area. So that I think that the cause is built here for lower prices. There may be a rally intervening that, and I'd like to see how good that rally is.
All right. So did you answer the question?
Yes or no?
My answer would be that I think it sees 2,000. I think this point figure count suggests 2,000 before 3,000.
Okay. So you're going with below 2,000. All right. I'm going to take the other side of it. I believe that we are in a bear market. I also believe we are in a secular bull market, though, and that these bear markets within a secular bull market do not last as long, and they're not as deep as the ones that we see in secular bear markets. So I'm going to go ahead and just show this one chart, which is one that I showed yesterday. And I may shorten it just so we can look at some other numbers a little closer. But if you look at this, after the late 1920s, early 30s, we went sideways for many years. We didn't actually break out again until the early 1950s, and we saw about a 2-decade rally before we went into this secular bear market, which is just a longer term time frame where you basically go nowhere. And when you break out of these secular bear markets, it tends to be very powerful secular bull markets. And we saw that back in the 50s and 60s. We saw that again in the 80s and 90s. And if you look back to the times, and I didn't go through and do the calculation to see if they were 20%, but I just kind of circled these cyclical bear markets, or maybe this one was a correction, but I think the others reached the 20% threshold. But you can kind of see that even in a very strong long-term uptrend, you do have periods of rockiness and market weakness. And I think that's what we're in right now. We had one that back in 2015, 2016 that looked like it might be heading for a bear market. I think we only ended up losing about 15 or 16% on the S&P 500 before we rallied. So it didn't qualify, but it was very similar. It was just a 1 year, maybe slightly more than a year where we went sideways, never really broke into that bear market. I think this time we have broken. I think we broke the key support level that was established back in February. I believe this is a bear market, but I think it's a cyclical bear market in a longer term secular bull market. So again, when I'm looking at these bull markets, these secular bull markets, I think that the bear markets within are going to be very short-lived. They're not going to be the huge percentage drops that we've seen in the past. I think a lot of this got built in December. I know there was one question. Is it reasonable to assume whether a bear market will last only a month? No, I don't think that's reasonable. I don't think that we just had a bear market in December. I think that the bear market that started back in October when the market topped was confirmed when we just recently broke down below the earlier 2018 lows. And I think we will have probably a couple of legs. I think we already saw one major leg to the downside. I don't disagree with Bruce in that I think the first quarter we could be a little higher. I think we might go down and maybe test that low that we just established a week or two ago. But after that, if that holds, I think we could establish a base there and could bounce one more time in the first quarter. And I think over the summer, we could maybe find our low. And I expect that this bear market is going to last 9 months to a year. I expect by the fourth quarter of 2019 that we are going to see a rally. And if I shorten this chart just a little bit, or maybe a lot, because it is a 100-year chart, but if we go back, say, over the last 30 years and update it, I think that the breakout that we saw right in here after that sideways consolidation, we broke out and then we came back down, tested the breakout, and then moved up higher, clearing 2,200. I think this bear market potentially is going to go back to about 2,100, 2,200. So maybe, the question or the statement, will it hit 2,000 before 3,000? For me, it's like splitting hairs. Maybe it gets to 2,000, but I believe we're going to hold around 2,100, 2,200. So I do think 2019 is going to be rough but I expect that it's not going to go down to 2,000. I think we hit 3,000 before we hit 2,000. So I'm going to take a slightly different angle. And, you all were talking about maybe 1,800. So if I'm talking 2,200, we're kind of still right around that 2,000 level. But so maybe it's just semantics here. But I'm going to go with no. So I'm the lone wolf.
Nice. So I know we have just a little bit of time too before we look at that poll, but somebody asked about what our large versus small caps forecast would be. Are you looking for them? For me, I think the small caps will basically play to whatever the large caps are doing while we're in this bear market. I don't see them pulling us out of it for sure.
That's a good question. I haven't really looked at the small caps, but I would say that I think that the U.S. economy is now beginning to feel the effects. And I think the small caps kind of warned us of that when they began underperforming earlier in 2018. So I think that they've already taken a big hit. I think they'll go lower, but I don't believe that they're going to go back down to where we were in 2016, which was down the 1,000 level. I suspect we'll probably bottom out on the Russell 2000 around 1,200. That would be my guess.
Mm-hmm.
Do you have any thoughts on that, Bruce?
Large cap tends to be where the quality is. Institutions will, when they start to, show the market some love again, they're going to buy the large cap first. They're going to buy quality first, and then work their way down into small cap as they get more confidence. So I would say that's the sequence that I would expect.
All right, sounds good. Here's the poll. Will the S&P 500, it was kind of related a little bit to what we were talking about, just a shorter version, but will the S&P 500 be higher at the end of the first quarter or on March 31st than we are now? And almost two-thirds saying no.
No, we will not be higher.
All right.
Being the doom and gloom person, it's really no fun.
I was just going to say that, Erin, I was going to say, I hope Tom is right.
Do too. I really do too. I just can't with my indicators. I just can't.
I'd love to be wrong.
I would too.
What do you think on this one, Bruce? I know you said the first quarter you thought might be stronger. I mean, do you think we'll be higher at March 31st than we are now?
Yeah, there's all these great climaxing declines into the end of December, and then a good bounce that we've had. And I am of the expectation that the markets, the big indexes, will be higher at the end of the first quarter than they were at the end of the year.
Yeah, I'm going to agree with you. I think we're going to go higher in the first quarter. I don't think all the bad news is out. I don't think that our economy is just going to turn around. We only got about 30 seconds here left, but I don't think we're out of the woods. I think the economy is going to continue to weaken. I think there will be more warnings down the road, but I think we're going to bounce. I don't think the market's just going to go down every day like we saw in December. For the most part, we saw in December. I think that we established a very significant low with the high volatility reading. If we go back down there and we can hold that low, I think that'll set the stage for a decent first quarter. After that, I think the second into third quarters could be rough.
Yeah.
All right. Well, that's about the end of the show. Again, thanks, Bruce, for coming on. We always love having you on the show. You know that.
It's just a pleasure.
I can't wait to get you back on here, and I'm sure we'll have some more interesting discussions about the stock market when you come back. All right, let's go ahead and wrap it up. Of course, I want to thank all of you for tuning in. It's always a pleasure to have you join us. Please remember to complete the survey as you exit. It's located below the video player. We'd love to get your feedback. Let us know what you think of 2019. I'd like to get your thoughts as well. We'll share that at some point on a future show. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. We'll see you back here tomorrow. Happy trading.